at it. I'll put the lube on.
Is there a way so like everyone else's audio is louder?
What?
Your audio is lower or muted, or not muted, lower.
That will fit. Okay, we're live now on YouTube as well.
Hello, this is Cem Karsan. How's it going, guys?
Hey, Jim. This is all is good. How are you?
Doing okay. I just heard a lot about you guys. Thought I'd hop on for a little bit and have a little conversation.
Thank you. Honored. All right.
Yeah.
Could you do us a favor, Jim? The volatility smile and how it looks on equities versus commodities, is that a thing?
I'm sorry, you mind repeating that?
The volatility smile and the skew of it normally, right? Out of the money, in the money. Does it have a different shape typically for equities and indices versus commodities?
Absolutely. So first and foremost, equities are almost always, I guess you could probably say always, on the whole, on the index level, always left skewed, right? There's always a fairly strong, higher volatility to downside options than upside. That's a function of simply the world is long, right? The world is long assets, particularly equities. People use puts, options to hedge. And so that drives a significant downside skew. I mean, structurally, historically, there's also the whole elevator down, escalator up, structure to markets as well on a realized basis. So some of that is warranted, but the reality is most of it is just a supply and demand function. Commodities are not always that way. Commodities are very much can be two-sided. You can have an upside skew, you can have a downside skew. It's a function of where we are relative to the risks in markets and what's going on. And that's obviously true for other assets as well. So the reason it's called a smile and not a smirk is because it's normally kind of more evenly distributed, but it can be smirking either way in theory. But there's an embedded structural demand to equity downside in particular that drive a structural downside skewness to the distributions. Hopefully that answers the question.
Do you think if you looked at a chart of skew, you could tell at a glance whether you're looking on average at one or the other as a way of, say, fingerprinting what the underlying is without knowing it?
For equities, I would say yes, for the most part. But again, like as I was mentioning, commodities, different kinds of commodities they can change significantly and have much less moored structure to the shape. That said, there are some telltale kind of things that generally apply to other products as well, as a function of supply and demand dynamics that are more structural. Those are generally a function of who is more prone to buy what, and is that a permanent feature or just a cyclical feature? But yes, I mean there are some telltale things where if you put different different smiles in front of me, I'd be more likely to get other ones as well. But skew particularly in the equity side is the biggest telltale that's kind of always there.
And speaking of curves, you've had some statements about the Fed interest rates, the concept of rho as one of the Greeks, which is related to interest rates. Do you think that has come more into play with options market makers as interest rates have moved around, or not so much?
So interest rate, so rho, particularly as it relates to equity and asset vol, is not. It matters a lot more for longer dated options or deep in the money options, right? I don't think the role of rho has been, and those aren't the most liquid things necessarily. So some of that is wind up. But volatility itself in interest rate options or areas in the market, such as currencies that are related to interest rates as well, have particularly become very kind of convex bets. We've talked about kind of the leptokurtic nature of this world we live in right now. We've talked about that for a couple of years. And it's being most kind of felt currently, kind of in this first chapter of this macro trend in the more first order places, which are kind of, again, interest rates and FX and the dollar. So we're seeing kind of vol in those products and vol generally really high. That is efficient, if you ask me. I think that's a trend you can rely on over a more longer period in those corners of the market. What we see historically during periods of higher structural inflation, which is where I believe we are, that the vol in those areas specifically really go dramatically higher and stay elevated for not years, but a decade plus. So I would continue to expect that to continue in those areas. The areas where I think it's been overdone are away from that. Industrial commodities, I think, have been dramatically overdone in terms of the implied volatility. We've seen that come back down a little bit from its peak. Again, historically, ironically, we see commodity volatility, not precious metals, to be clear, because those are more of a currency and interest rate tied product. But we see industrial commodity volatility actually decrease historically during these periods, ironically. And if anything, skew turns, the put side really flattens on the industrial commodity side. So I think there's a mispricing there. If I'm correct in my macro view, which again we have been for several years now, I think that's an area where there's an opportunity. But again, I would expect interest rate vol, FX vol, dollar vol, even precious metal vol, which are all kind of that same broad complex, should continue to stay elevated, and there should continue to be opportunities for buying vol on the dips in those products in the years to come. So hopefully that helps a little bit.
Indeed. So the trend recently, by your measurements, has been that realized vol has been much lower than implied.
No, I mean, it depends on where you're looking. Absolutely, on equity vol, that has been the case. Market down, vol down has been an incredible opportunity in index vol space. And again, that's been a function of the fact that the world is primarily hedged in that world. It's one of the more liquid spots in the market. And some of the, in this first chapter of higher interest, inflation, it's, similar to what we saw 60, call it 6 to 70, going into the first recession of of that time period. We really saw, reduced equity vol actually in the first kind of steps of that, that first inflationary period. And so this kind of jives with that in the equity vol space. Generally speaking, when the Fed loses control and people lose faith in the Fed's ability to control inflation, which has yet to happen, if that does end up happening, which I believe it will eventually here, that's when equity vol, which is generally one of the last to go, does historically spike for some multi-year period. So currently that has been the play in particularly in the equity space, but everywhere else, again, other than industrial commodity, which I think is an opportunity the other way, has actually been opportunity to be long the tails, long vol. But again, the shorts there should be industrial commodity vol as well as equity vol in the short term, with a turn to equity vol and even commodity vol increasing in the coming year or two.
Now, you're pretty active on Twitter, and Twitter has been sort of the hub of the gamma Armageddon theories, Volmageddon, zero DTE options. Summertime, there was a big fear that they were going to dramatically change how, especially the indice options were trading. How has that played out since the summer? Has it been the cataclysm that was expected?
Yeah, obviously not in equity vol world, right? And we've largely talked about how that was, not going to be the case for several years now. But the way these things work is, by definition, if people are expecting something and there's an overwhelming attention to a likely, what is believed to be a likely outcome, almost by definition, reflexively, it is very hard for the market to, kind of perform in that way. And that's kind of because of the reflexivity of positioning itself. So if people are hedged for an event, broadly speculating on downside outcomes, not only do they have profits to take, supply to put on the market, bids underneath the market, sales of puts come in when the market declines. But even more importantly, what that means is dealers are short put or short that position. And as things don't happen, there's a natural reflexive counter move of dealers buying back equities, or underlying assets. So that's that Von charm flow.
Yep. Yeah, is that Vana flow right there?
That's that Vana charm flow I talk so much about. And the realities are these reflexive flows have been, the reason implied vol has really become compressed despite all the macro realities. The more people are positioned for these outcomes, the less likely they are to occur. So the way these things usually play out is you get a first move where people are expecting something, doesn't transpire, vol underperforms dramatically, time passes, theta, is experienced, vol compression drives losses, and managers who are long vol, get hurt and get redemptions. Managers who are short vol get rewarded and build bigger positions and become more greedy. And, this is the crowding in and out of positioning. And this is dealer positioning at its core. As dealer positioning gets crowded and people are now saying, volatility in equity land is dead. Look how much money I've made betting against it, yada, yada, yada. Eventually, the macro realities will play out. It's just you need that weakness in positioning to occur beforehand. So, by definition, shorting markets or short, trying to take advantage of tail events that are well understood or publicized is very hard. Maybe even impossible. So yeah, you need time. This is why it almost always takes longer than people expect for macro, realities to play out. It always, there's the adage of most people will know that, it's harder to stay, markets can stay irrational longer than you can stay solvent. And that's what drives that. That's the whole concept. I've talked about it, that knowledge is vol dampening, right? So broadly, that's how markets work. So, you're really looking for, you have to have a secular opinion and understand the secular flows that are likely to drive a long-term outcome, have conviction in it, and be watchful for the time when positioning, which is so critical, turns against that secular view. That's when the big payouts happen.
This ties into, I guess, the understanding of trying to map out and chart levels like GEX and this concept of gamma flip. Can you just give us a brief description of gamma flip in particular?
Yeah, I'm going to be clear. I think the toy model that exists out there of GEX or gamma is it's a wonderful summary of a much bigger idea. But just like anything, if you get something 70% right and you assume it to be 100% right, it helps you in 70% of the scenarios. But then, in the other 30%, not only are you going to lose, but you could lose really big because of the incorrect assumptions you make. So I think there's a lot of problems with how these GEX models work and these third-party kind of entities who provide, gamma supply info. Again, open interest is the tip of the iceberg. Understanding who is what kind of customer, who is what kind of dealer, what they, what their reaction function is, and more importantly, all the things that are off market, structured products in particular, and how they are affecting the picture, and then pairing it with kind of broader flows is a very critical kind of approach. So it's not just about a flip point, right? Yes, options positioning matters. Understanding what that positioning looks like for dealers broadly is helpful. But again, it's that last mile, which is 20 to 30% of the answer, that is really the really hard part, and the part that ultimately is critical if you're going to get this right. Again, doesn't mean make what you're getting there useless. I'm not sitting out here saying it's completely useless, but it is dangerous to make assumptions based on a model that is, very simple and ultimately flawed.
Especially with the indices, do you think time of day matters for people playing the shorter term? Like the idea that there's not a lot of trading going on in the second hour, or 2 p.m. is a magic hour, and so on?
Yeah, I mean, absolutely. There are different types of trades. There are trades where you're taking advantage of structural periods of an expiration cycle, like I often talk about. There are trades where you're looking at much more secular 5-year fundamental realities or flow realities of trades. And then you have trades which are, much more day-to-day, hey, how's this market going to move over what hour period? So they all have realities on a micro macro scale. So if we're going to talk about the micro, zero DTE option type trades. There are, again, it's important to understand the reaction functions. Who are they? Not just what is the positioning, but what is the likely reaction function of the entities holding this positioning, right? And how and when, importantly to your question, do they unwind them, and what causes them to buy back stock, sell stock, buy back vol, sell vol, to balance their portfolios. And so the more you can understand that, the more you have some insight. Obviously, the more sophisticated players like market makers are going to have, a lot of the information that you have, and are going to be trying to hide and change that the timing of these things as well. But they do have ultimate constraints from their prime brokers, from other entities, and those constraints ultimately help you determine some of the realities. But more importantly, those primes, those banks, those other funds that ultimately have maybe more, especially with structured products, bigger structured positioning, have to move over certain specific time periods, particularly beginning and end of day. You could have, even more of an edge or trades around that can be productive. So again, without being too specific, hopefully that gives you some insights. But yeah, really these banks, bigger entities that have to hedge and to move, balance their Greeks, particularly end of day, beginning of day, can be a specific edge to zero DTE trades.
Oh, thank you very much for those answers.
Mm-hmm. My pleasure. I think we got about 5 more minutes here. So if you have any other questions, dive in, and then I'll give people here a little chance to kind of know where to reach me outside of here if they want a longer conversation.
Yeah, I want to ask you one last thing and then do that. The futures markets have had this assumption about interest rates for the past 2 quarters. How do you think that played out, that gamble and that positioning?
Yeah, so the chronology is pretty clear. We had a story of transitory inflation early on, and positioning reflected that, despite the secular realities of the underlying money flowing to demand and the labor circumstances. And ultimately, that drove a pretty massive convex trade, in rates, early on. As people began to realize, oh, wait a second, this is likely a more secular story, but in positioning, being on that train became much more profitable and consistent, much like most strategies. We quickly moved to a positioning circumstance where people were overweight everything that worked in a more secularly inflationary world. And when that happens, despite what those secular realities are, people get too far on one side of the boat, you're going to see a counter trend move. 68 to 82, a period I talk a lot about, which was the last major inflationary period, 14-year period, saw 3 recessions, 3 dramatic moves cyclically lower, cyclically lower in Fed funds rates, broader interest rates, inflation, but consistently higher and higher, lows and higher highs in inflation, Fed funds, and yields writ large. And so there's a secular story and a cyclical story always. And generally the cyclical story, particularly when the secular narrative gets so strong, a position gets so strong, is paired with major counter trend moves and a readjustment of narrative. And so, this is part of that back and forth that you see. It doesn't change the secular realities of the circumstances, but we are in kind of chapter 2 or so of 10 to 15. And, the first 2 chapters were secular, and, this 3rd chapter now we're seeing a unwind of the narrative a bit, a rebalancing of positioning, and that's likely to happen until broadly a more deflationary narrative, is more balanced, and the word transitory ends up on people's lips again, which we're broadly heading towards quickly here. And then you're likely to see, with positioning rebalanced, a move towards, again, the secular, back onto the secular trend. So that's how these things work. It's not just cyclical anymore, where once you have a secular effect, which we have not seen for some time, and there's real core structural reasons for it. The key is to not lose sight of that, but to understand within that secular trade the cyclical realities.
Okay, Volatility Advisors. Thanks so much.
Yeah, happy to be on. Thanks for having me, guys. And if anybody else wants to reach out or is interested in chatting, Kai Volatility.com/news. You can also schedule appointments to kind of talk to us or the team. Just feel free to reach out there.
Jem, I have one last question here, actually. Word on the street is there's a wealth advisory business coming in a few months. Would you like to share some insight on what that is?
Yeah, we've actually purchased a small wealth advisory firm, and we've had a lot of questions over the years about, hey, listen, love your hedge funds, love your products, great diversifier. But obviously, they really occupy, a place for me to, for our investors to put, 10% or so of their net worth. How can you help me, broadly in this, inflationary period to apply a more diversified approach to investing in this regime? And so, we think there are very few people out there doing this and talking about kind of this 10 to 15 year, time that will be less about, buying beta, dollar cost averaging, much like 68 to 82. We think, risk assets are likely to go sideways. Nominal returns during that period were zero, and real returns were negative 70%. We think we're likely to see a similar scenario where you really need to approach investment in non-correlated way. So, we believe we can do that with our wealth advisory product, which we're launching in the next 2 months. We already have, strong commitments across the board, and obviously conversations we're happy to have with others that are looking for an alternative to that 60-40 wealth advisory world, which is 99% of what's out there these days. So again, if anybody's interested in having that conversation, reach out to us at kaivolatility.com, and we're happy to have those conversations from there.
Jem, thank you very much for your time.
All right, thanks guys. Thanks for having me. Be well.
Bye.
User left your channel.
Damn. Hey, is my mic sound okay?
No.
Is there feedback?
No. Let's go back downstairs.
User left your channel. User left your channel. User left your channel.
Jem, you still there?
User left your channel. User left
Yo,
your
Wolf, can you hear
channel.
me?
Left your channel.